There has been a substantial increase in landlords exiting the market, with increased regulation, soaring operation costs, but also rising mortgage rates. Landlords are feeling the pressure. But the real squeeze has to be the tax changes that we've seen over the course of the last 10 years. With buy-to-let purchases down by 14% of 220,000 the year 2022-2023, down to 190,000 June of this year 2024. It is obvious that combination of all of this is having an impact on landlords. In this video, I'm going to share with you 5 major tax changes that are driving landlords out of the buy-to-let market. I'll also discuss how they're mitigating this impact, but do stick to the end because there's a rumour that may be the final blow when it comes to tax to private landlords. Stay tuned. Let me take you back to 2015 when all of this began. The Chancellor George Osborne argued that it was intended to level up the playing field, that at present landlords could offset their mortgage rates whereas homeowners could not, and it was unfair. The introduction of Section 24 was phased in between 2017 and 2020. Now the rule limited landlords from offsetting their mortgage interest costs from their rental income, replacing it with a 20% tax credit, and of course landlords' taxable profits, but also overall tax bill went through the roof. A typical story includes a professional landlord like Michael who I found online. Now Michael's main income is from rental and it's £110,000. Now, as a professional landlord, of course, he has multiple properties. And with these new tax changes that were phased in up to 2020 in April, this could have a huge impact on his bottom line. Let's assume that Michael earns £110,000 in rental income and pays £27,000 in mortgage interest costs. The amount of tax Michael would have paid would have been totally affected by the money that landlords could now write off for tax purposes. As we can see, as that 25% dropped, we can see that in 2017, starting from £23,000, went all the way up to almost £30,000 in 2020. If you're a landlord impacted by these changes, leave me a comment below. I'm always fascinated about landlords' experiences across the country. And yet this change of tax treatment of mortgage interest was just one of many announcements in increasing the tax advantage of owner occupation against buy-to-let rental income. The 2015 autumn statement announced that by April 2016, there will be a 3% stamp duty surcharge on any properties that were purchased that wasn't intended to be the buyer's main home. The government introduced this surcharge specifically targeting buy-to-let investors, and it was aimed to slow down the property market, specifically the buy-to-let sector, discouraging landlords in getting additional properties, but perhaps even entering the buy-to-let altogether. Now, to explain this and to give you an example, let me give you William and James. Let's look at the typical case of William, a hopeful home buyer, a working professional in his 30s, renting for years and dreaming about his first home. On the other side, we have James, the aspiring investor, in his 50s, been working for over 30 years as a sales manager. Now, he already owns a property, but he's only just found out that his pension pot is going to be worth nothing as he reaches his 60s. So he's decided to buy a second property, but he's faced with a dilemma. Let me explain. So William, buying his first home for £500,000, will be paying a total stamp duty of £12,500. It's a total effective rate of around about 2.5% when you add up all the tax bands. However, if we look at James, the aspiring investor who wants to build his pension pot, James will be paying a whopping £27,500 stamp duty bill. That's a total of 5.5% effective rate, again, when you add up all the tax bands. This is the dilemma that buy-to-let investors have been facing since 2016. And the fact that the buy-to-let industry is always changing absolutely means you should subscribe to this channel so you don't miss a thing. The 10% wear and tear allowance were removed on the same year. Now landlords can only claim on actual costs incurred. Wear and tear is now treated like any other expense. You actually need your receipts to be able to prove that expense, which makes keeping those records much more important, but also much more time consuming. And if you want to check out the 5 new policies from Labour, make sure you check out my video above and on the description. In the last 10 years, there have been significant changes to capital gain tax when it comes to landlords. The annual exemption has been reduced multiple times, from £12,300 to £6,000, and this year down to £3,000. In addition to that, since 2020, landlords who sell their properties and have any capital gain tax to pay must do this within 30 days of completion. Now this was changed, and so that compliance, that timeline has been reduced significantly. But that's not all. There are rumours of capital gain tax hike, which could be the straw that breaks the camel's back for landlords. So in an interview, the Chancellor Rachel Reeves refused to rule out that there was going to be an increase for capital gain tax. And an analyst has reported that fears from landlords about capital gain tax increase can disrupt the market by masses of investors going into the market and selling off their properties. And of course, this is going to impact the rental market as well. As speculation grows, there are going to be potential property investors who say it's just not worth the risk. They're going to sell up before autumn and create a glut of property for sale and keep prices down. If you're finding this video helpful, make sure you smash that like button. It really keeps me motivated and pushing more of these out there for you. So what have landlords been doing to mitigate this impact? Well, a lot of them have been incorporating, so opening limited companies, so therefore they can actually offset their mortgage interest, as opposed to if it was on your personal name, they could not. However, that does have its challenges. It is a costly affair. It is ongoing expenses, and also it can be expensive when it comes to mortgages, as lenders do tend to spike up the interest rate for those limited companies. The introduction of Section 24 as well as other tax changes were introduced to create a more fair tax system, but also to reduce the financial instability that was coming from the buy-to-let sector. However, it has created consequences for both landlords and tenants. A lot of landlords, of course, are facing high operational costs, rising mortgage rates, regulations, taxes, and so forth. A lot of them have been able to mitigate some of that impact by incorporating, by having a buy-to-let company and having the properties there. They can offset those mortgage interest costs. However, others have decided to exit the market, and we continue to see that in 2024. My last two words, cause and effect.